Bobby, you didn't look nearly as much like a gangster in the picture they're using for that one, so I think that's good.
I've been told I look more like a gangster in that picture. I don't know
You
I don't
think
know what I'm
so?
supposed to do.
I don't know. Yeah, you look like a gangster no matter what.
Hmm?
I think there's people actually watching now, so let's start the podcast. Welcome to the Trader's Edge podcast. I'm Jim Urio, brains behind the operation, executive producer, co-host Bob Iacino. This is going to be really fun, in my opinion. This is a new show that we're launching. It's going to be geared more toward the trading community. What we like to do, generally speaking, is Bobby and I kind of describe our trading style as 60 to 70% technical, 30 to 40% fundamental. And we love to really break down the macro and then bring it down to its effect on certain asset classes. Today is a great day to talk about stuff because there is a hell of a lot going on. Bobby, what do you think are the main things we should be addressing today?
Well, I think we should be looking at kind of an order of importance, and I should say a reverse order of importance. I mean, we had the BoJ on Friday actually adjust their policy. I don't even know how to word that because they didn't really make that big of a change, but it's also that big of a change, for them to actually do something. They haven't really done anything in this direction. I mean, you could say in a couple of decades, really. And they haven't had inflation in a couple of decades, and now they finally do, and it's going to affect the markets. And one of the things I want to tell the people watching is we're going to try and get you guys to understand the why of what's going on so you could focus on the what in terms of what you have to do to actually get better at your trading, get more profitable, manage those losses, manage that risk better. We're going to talk a lot about managing risk because risk is cheap right now. But in terms of what's going on, I think we have to talk about what the Bank of Japan did.
Okay, well, that tacitly saying that the downgrade by Fitch is nothing to you, or no?
No, because this is in reverse order for
Okay.
me. I'm going to go from the least important thing that
Okay.
matters. But the key part is that it does matter, right? It
Okay.
matters a
So,
lot.
right, the Bank of Japan thing. You and I talked about this offline yesterday. This is going to fuel a trade that I'm going to put on from the Bank of Japan. Because here's what the implications as I see them are. You can fill in if I'm getting something wrong. So the Bank of Japan that hasn't seen inflation in 40 years, whatever, let's say 50 years, doesn't matter. All of a sudden, inflation is starting to show itself. And they've had this yield curve control where they've had zero yields basically throughout the whole yield curve. And it was change in the 10-year, not zero, but don't hold me to that. But anyway, if they're going to all of a sudden let their 10 yields go higher, that means our 10-year yields are going to go higher. That, in my opinion, at the same time, the disruption of the market could kind of move our Federal Reserve into being a little less hawkish and a little more dovish, which might depress front-end yields. And I think the curve is going to go back towards zero. And I know a lot of you guys who are watching this trade stocks and gold and oil, and we're going to talk about that stuff too. And I know rates is getting in a little bit of the weeds, but I think this is interesting stuff today. You like that trade? You don't like that trade?
No, I do like that trade. Look, here's why I think this is important for equity traders as well. What you're looking at here is now we all talk about how many treasuries China holds. Japan is the king. And Japan has been for a long time in terms of US treasuries. And part of what drove money out of Japan and out of actually a lot of the countries in Asia into the US was the rate differential. We all talk about the carry trade, right? Where you borrow from a country in their currency that has low rates, and then you invest in a country that has higher rates, i.e. the US. And all you do is hedge your currency risk and you let that money sort of accumulate. These kinds of moves leads to soft unwindings of that carry trade. So what's involved with those unwinding? It's selling treasuries, which is exactly what we're seeing with the higher yields we've seen. I'm not saying that this caused it. I'm not saying that the Fitch downgrade caused it. I'm saying we're seeing little things that are causing a shift in the yield curve, which is part of the reason you want to put on that trade, where the yield curve is actually going to go back to its rightful shape a little bit quicker than maybe people thought. That's why I like that trade.
Well, so what's irritating is that all day I've been real busy today with client stuff, so I didn't put on the trade. And I know I'm going to come in. I'm going to log into my screen tonight, and it'll be already running in my direction, which is going to irritate me. But I'm going to do this well. You mentioned currency risk, and it should be important to remember that when you're borrowing in yen, you have a lot of currency risk. Right? I mean, and when you're long yen to buy, whatever. So you get what I mean. The yen has been pummeled through these things. So I think it's really interesting. And again, I will add, that this kind of Thursday night, Friday morning, there was just a whisper of it that came from the Bank of Japan. And the market doesn't really think it's a huge deal yet. You agree with that, correct?
Yeah, and actually, I'm gonna put up a chart. If we could put up this JGB chart here, this kind of illustrates what you just said, that the market doesn't think it's that big of a deal yet. This is the Japanese 10-year or the JGB yield. Okay, so you can see on the left corner of the chart here. I'm actually going to see if I can annotate this chart. Jimmy, you're going to have to tell me if I'm actually doing it. Can you see my cursor right now, Jimmy?
Well, first you have to tell me what annotate means. I'm a math guy. I don't know your fancy English.
Yeah, I don't really know what it means. I made the word up, and I'm hoping it means what I want it to mean, which basically means mark up the chart. But now I've decided I don't even know how to do that. So let's try this. Let's try this little thing here. Is that writing? It is.
Yeah.
Okay, so this little circle I just drew is basically the aftermath of the BoJ's decision, right? Which happened on Friday. Here's Friday, right? Actually, this is Monday. So it happened on Friday, Sunday night, Friday morning, whatever you want to call it, Friday night, Sunday morning. And this is the first effect of it, right? Basically right here where I'm going to put my crosshair is the old level that they were holding rates below, 50 basis points, right about where my crosshair is right there. Okay, so right about where I drew that rough line. That's 50 basis points. That was the old cap. So that meant that the Bank of Japan at 50 basis points was going to buy the hell out of the JGB to keep rates there or push them lower, which they did all in this area of the chart, right? They were able to keep it below that level. Even in here where people tried to spike it, investors and traders tried to spike it above, the Bank of Japan smacked them, right? And pushed it back down there, and they lost money on that trade. Now they're allowing it to do it, but you see that the market is barely testing it. We have rates that went from 50 basis points to 62. All right, so that's from half a percent to about 0.6%. Yeah. And the Bank of Japan hasn't done anything yet. Now they have said that they're going to at least let rates float to about 1%, and they wouldn't let it go past there. And the market's not taking it to 1%. That tells you how little of a deal it is. So this is one of those things where it's a big deal, but it also, market's afraid to test it.
Okay, so when we say traders, when you made that circle, I prefer we call them evil speculators. I think that's what they're called. So the evil speculators try to test it. So now for people who are watching, the machinations of them doing yield curve
I don't
control,
think that's a word, but go ahead.
Machinations is a word, I swear to God.
It's machinations, but go ahead.
Is it really? But anyway, so they have to buy bonds to keep rates at the yields they want. What are they buying with yen? Where do they get the yen? They create the yen. That's why the yen has absolutely imploded over the last couple of years. I believe it's down about 25% against the euro. Against the dollar. Right. Is that correct? Yeah, that's right. So that's if people who don't trade bonds, don't trade currencies, that's an interesting little side note of this is that the currency market is showing you that they're probably getting toward the end of their ability to do this. You think that's a fair assessment?
I do. And I drew this big blue arrow mostly because I was trying to figure out how the arrows worked, but also it kind of goes from that 50 basis points breakout where the Bank of Japan actually pushed it lower to where it is now, where the Bank of Japan is not pushing it lower. So anyone who thinks that this wasn't really, that the Bank of Japan wasn't serious about it, the market is testing levels right now. Right. So how's this going to affect markets? Right. Well, it's going to affect markets because at some point, the Bank of Japan is going to either let it go further than evil speculators thought it would, or they're going to smack them back down. And that's going to cause a bunch of sort of dominoes to fall. And actually, that's one of the things I want to talk to. We got Steph Pomboy on our podcast next week, not this one, but our Futures Edge podcast. And this is one of the things I want to talk to her about.
No, that's good. And again, so this is important. I don't recommend trades, but I will tell you what I'm looking at and what I may do. And the steepening trade, what do you call it? You call it a steepening trade, even though it's going back to zero. And technically the curve is inversely steep, but I want it to go back to zero. So I will probably be doing that by buying the micro CME 10-year and selling the 2-year. That's what I would do. The CME and again, I don't want this to be a commercial for anybody, but I do use their products and I like them. But they just came out with a product that you can trade them both in tandem. Did you know that?
I did. Yeah.
Yeah, you can trade the 2s versus 10s. Okay, let's move on to the Fitch downgrade, which I think is partially comical, partially interesting. I'd like to get your thoughts on it first.
So first of all, this is another situation where it's a big deal, but it's not. Right. So Fitch just downgraded the US from AAA to AA plus. That's where Moody's and S&P has had the US since about 2011.
I thought it was just S&Ps. Moody's too has them
Well,
below
Moody's
AAA?
did it. Well, actually, here, I could put something else up. I don't know if this is going to work. Hang on a second. Okay, guys, we're going to have a little bit. No, I'm going to have to actually show this. So let me show one more thing here, and I can switch back and forth then. So I'm going to put up one more thing. Let's see, share screen. I didn't anticipate sharing this, but this will help answer your question. So this is Wikipedia, and I'm not sure if I should trust it or not. Can you see it?
Nope.
Tell me when you can see it. Those guys got to put it up.
Also, welcome to our first show here. So it might be a little bit of growing pains. Okay, what do we got?
All right. So if I justify this by rating, right? So here's all the AAAs, and this is Fitch, right? Here's S&P. Now you notice down here, the US is AA plus, right? Standard & Poor's, if I click on that, the US is AA plus. Let's see where Moody's has us. Moody's, let me go back to rating here. No, you're right. We're still stable at
still AAA.
Moody's,
yeah.
Right? So anyway, back to the point. The point being that the big deal is if the other rating agencies follow. So if all of a sudden Moody's downgrades us to the same level that Fitch does, if then S&P decides, well, now they're AA instead of AA plus, that causes forced treasury selling. And again, we're going deep in the woods on rates. I get it. We'll get to equities. I'll get to some individuals. Jim will get to the S&P. But what you're talking about there is forced selling of treasuries, which causes forced higher rates.
Because pensions can't hold things that aren't AAA rated. In some
not just pensions, but several institutions have mandates where they say you can only invest in AAA. And a lot of that just defaults to treasuries, especially recently, now that treasuries actually yield something. Some of the underfunding of pensions has been because treasuries have had no yield. And now all of a sudden we get into a situation where treasuries have yield and these pensions can actually start to catch up again. And now we get downgraded and they may not be able to. If there's pensions out there that use Fitch, they have to sell.
So tell me this, do our new partners on this podcast mind if I use the expression bullshit or no?
No.
Okay, good.
We're right fucking ahead. It's fine.
Because this is an absolutely bullshit thing that's happening, and I will say why, and I'm curious if you agree with me. Okay, the reason these rating agencies exist is to be a buffer, to be an analytical buffer between an uninformed public and the potential bond that they may be investing in. The notion that Fitch, S&Ps, or Moody's can add anything to the analytics of U.S. government treasuries, which are the most traded, the most analyzed, the most overanalyzed asset on the planet, is comical. And to do this out of the blue, and again, we are running up massive deficits. And this is weakening the currency. But anyway, to downgrade our bonds, it means that there's risk holding the bonds that you're not going to get paid. That's stupid again, except, you are going to get paid. They have a printing press. You might get paid in a garbage currency if they keep printing money and damage the US dollar. Let me go here. He's on a roll.
Keep going.
So the point is, I'm saying is that this is really just a downgrade of the U.S. of the currency, of the dollar and dollar policies, right?
That's exactly what it is.
Unless you're saying that the machination of paying is fine, but the politicization could potentially come into conflict again with actually paying out bonds. So that's a genuine risk if two political parties can't get along and they decide to shut down bond payments, a technical default that could morph into an actual default. But the reality of it is, this is not like downgrading a tier 2 auto manufacturer who might not be paying its bonds and maybe close to bankruptcy. It's kind of bullshit, yes?
I had a drink down here in Southwest Florida with a guy who's been on our other podcast, very well-known guy. I'm not going to say who it was. And he maintains that any analyst, not just a Fitch, Moody's, or S&P, but any analyst, and this is to people watching now who might trade ETFs or might do call flies or call spreads off of a stock, off of an analyst upgrade. Okay. Long term, those things mean precisely nothing, because this particular person has been in the room, and I've been in one of those meetings, but he's been in multiple meetings where they basically said, look, we can't downgrade them to sell because they're a client. He said basically all holds are sells. That's what he said. Okay. Now I can't say who it is, and I'm not going to say who it is. I'll tell you in private, Jimmy. You know him very well. And it's one of those things where when you look at this kind of a downgrade in terms of what the value of a U.S. Treasury is to an institution, tell me what's better. I mean, I'm looking at that list of other AA countries. Let's put this up again. The list of other AA countries, right? Now, this is per Wikipedia. So you, as a pension fund, you think you're better off being in the bonds of, I don't know, pick one of the AAAs. Luxembourg?
Yeah,
maybe.
no.
I mean, you're better off being, by the way, Singapore has about 136% debt to GDP ratio. It's somewhere in that range. Sweden, you want to buy Swedish bonds? Okay, fine. You got currency risk in those. You think that you're not going to get paid? You're worse off trying to risk getting your money from the U.S. than you are from the Netherlands. I mean, first of all, if the U.S. can't pay, neither can any of those.
No, anyone else. Now, I will put a finer point on that. Like, we're debating whether or not this is a bullshit rating. We don't have to debate it because I can prove this unequivocally. Why, you ask?
Why?
Back in 2011, when S&P did the first downgrade in my lifetime, the markets were a little bit disjointed. Stocks broke a little bit too. What happened then? All of a sudden the flow started to go in to U.S. Treasuries as the safety trade. So the very thing that was downgraded ended up through a small chain of events was the thing that was being bought to protect yourself from that thing being downgraded. Okay, so now I don't think that quite happened today, but yesterday and today, you saw the dollar, the US dollar, which I just made the argument that it was the thing that's being downgraded because you're going to get paid back. What happened? The dollar rallied.
Yeah, the dollar is still up today, by the way. So I don't know, Jimmy, you kind of froze there, so I'm going to keep talking. But the dollar is up today. Okay, so you now have 5 consecutive sessions of a higher dollar in aggregate. You have 11 of the last 13 sessions. This is what Jimmy was referring to when he said the exact thing that was being downgraded, which is de facto the US dollar when the Treasury's bonds are getting downgraded, was what people rushed into to protect themselves. So a question for you. Is that part of why the markets are dropping today, given that regardless of whether we think this is bullshit or not, it still means that money costs more?
Right. It does mean the money costs more, but there's something more important to it as well. I think we've been on somewhat of a one-way street for a long time. Market positioning gets to a spot. Bobby just talked about volatility being so incredibly low, options being cheap, protection being cheap. We spent weeks with the VIX under 14. People were getting bulled up and too much on one side of the ship. So is this an effect? Yeah, if money costs more, it's definitely going to have an effect. But more importantly, people are just like, is this a real risk? Maybe, maybe not. Do I have too many stocks on? Yeah, probably. So it's time to sell. And that's one of the reasons we use technical analysis. And we are breaking through what I think is a fairly major technical spot. And if we settle, and we're going to talk about stocks a little bit more, but if the S&Ps can settle solidly below 45.50, which they were trading at 45.37 the last time I saw, this is the S&P futures. We're in the SEP contract. If they close below there today, I believe that's a significant signal. That's probably the 5 to 8% correction is afoot. And it's not necessarily because of the fundamental story. It's the fundamental story coupled with market position, which creates the need for a correction. Make sense?
Yeah, it does. We got a question coming in on this, Jimmy, but just real quick to update everybody. The September S&P futures are 45.3650. The SPX, that's the Dow Jones S&P index, 45.1367 as we speak. So the question for funds needing to hold AAA rated assets, can they hold an asset that is rated AA plus by 2 agencies and AAA by only one agency. Now, I know the actual answer to that. I think you do too. You want to take it?
No, I want you to take it because
All
I
right,
don't know it for sure.
Within the institutional world, you have disclosure documents, and those documents, even with pension funds, describe exactly what you are allowed to hold. So it will say in your documents, if that's a possibility, it will say that. Okay. Otherwise, it will say as listed by Fitch or as listed by Moody's. Oftentimes they say as listed by two of the three agencies, which is part of the reason this is a bigger deal than people may think. Because it often, some of the documents I've seen over the years when I was at my fund of funds, especially, they said as listed by two of the three major rating agencies. Just like when you would ask for an audit, it'd say audited by one of the big five. It gives you that option. So there are definitely institutions out there that say as long as one of the three agencies has a AAA rating, you could buy them, but it's very specific in the documents.
Bobby, though, is it not? I was under the impression that once the second domino falls, the third domino is usually relatively quick to follow. There's no benefit in being the one holdout. It's better to be all three of them to be all wrong together than be the one that's wrong. So my guess is soon that will that S&P or Moody's, whatever, will change its rating as well.
And there's something we have to look at with this before we move on is how much of it. So there's been a lot made of it by pundits, of which I guess you and I used to be and somewhat still are, that this announcement came right before the next Trump indictment. Now, we're going to try and avoid politics like the plague in here, but there is some talk, some chatter that the sort of stability of the political system here is part of the reason that Fitch caved.
They said it, though.
Yeah, they said it in their statement, right? They said that there's some political instability. I don't know if they were as specific as, for example, CNN said they were, but yeah, I don't. So anyway, moving on.
No, but to your point though, that's not, I mean, if Fitch is downgrading U.S. debt, which is what we trade, which is what we think is basically the dog and everything else is the tail, if they're telling us that it's because of political instability, then political instability needs to be spoken about by financial analysts. It's not political to talk about it. It's policy, right?
That's a fair thing to say, yeah.
Good. Yeah. We hate both sides equally. Just now, that's not true. We hate both sides is true. But
hey, one last thing on the Fitch thing, because when you said we hate both sides equally, it reminded me that we both kind of hate the Fed. And one of the things these agencies do is there's so much opinion. You know, part of, again, that guy that we both know that said, I've been in meetings when they said we can't go to sell because they're a client. When you have people involved, things kind of become bullshit the way you mentioned it. Similar to the Fed, deciding when inflation is transitory, then deciding when it's not, then deciding that they need to aggressively, I don't know, destroy the regional banking system, and then deciding when they need to aggressively pull back and deciding when they need to switch. If there were actual mechanisms in place, for example, if the ratings agencies, at least with government debt, said when your GDP gets to here, you lose a rating point.
Your debt to GDP.
Debt to GDP, sorry.
Right.
Yeah, when your debt, if that, and there would have to be more than that, obviously, but if they actually put mechanisms in place that were transparent and understandable for the average person, nobody would have any questions.
Yeah, and as the Fed should be doing that too. The Fed should be managed by a computer, except for the fact that some of the data points they use to measure inflation, I question and challenge. So those would have to be revamped as well. But I agree with you 100%. The Fed is doing a great job in cleaning up the mess that they completely caused in conjunction with the government, which, by the way, we bring up the Fed. That leads us into now speaking about some of the asset classes that we want to talk about on this show. Because should we start with stocks?
No, let's actually start with crude oil because that's going to take me to a couple of energy stocks.
Oh, good. But let's do that. I'm just grabbing a water out of the fridge because I got a little bit of cough. So keep going. Yeah.
Crude oil is in a very interesting place. We actually talked with Mike Arnold, who we will have on this show, is my business partner, and he's also just a cherished technical analyst that Jimmy and I talk to all the time.
Outstanding.
He is outstanding. I mean, and I actually mentioned it to the guys we're doing this show with, that he just simply has to be on. We talked about crude oil with him yesterday, and he talked about how crude oil had kind of made a breakout that then was sort of waiting on a pullback that holds. Okay. We're getting that over the last couple of days. Now, forget the reasons why we're getting it. This is why I said what I said in the beginning of the show, is that for a lot of times people are like, well, why is this happening? Right. And you end up kind of screwing up your active investments, wondering why something is happening. If you haven't reached your risk point and you haven't reached your take profit or your sell covered calls or whatever else that you do in your particular strategy, when you focus too much on why, you really screw up your process and your plan. But so one of the things that both Jimmy and I do, and we did this before we knew each other, so we didn't get it from each other, is we like breakouts, retests, and holds. And you're getting that retest right now. It's not here yet, but the couple of days lower that we've had in crude oil, especially today, might be the time to start looking not only to get into crude oil futures contracts if you have a futures account, but energy names, like some of the downstream energy names that people look at. You might want to be looking at calls and call spreads and even the outright stocks, because some of these things going into, people start to look at those and they say, okay, well, we're going to come out of the summer driving season and that's not going to be so advantageous. And seasonality is a mother effer, right? I mean, it's a big deal. But if you have the thick of hurricane season coming, right? Supply being withheld by OPEC, exploration, okay, U.S. exploration, looking for more oil. They ramped up funding to the highest level since 2019, yet the finds, okay, the discoveries of actual deposits of crude oil are 42% lower than this time last year. So we have reasons to think that there might be supply issues. Now, we also have a globally slowing economy, arguably, right? Not everybody agrees with that, but you could have a real supply crunch right as we get into the meat of hurricane season.
Tell them the good part, Mortimer. The most fun part you're missing.
What's that?
Is that if it starts to run to the upside, there is a very real possibility that OPEC might even welcome that, for the notion that the U.S. might have to refill the SPR, which they've extremely depleted.
Oh, the SPR.
Again, the SPR.
The SPR.
Part, right. Yeah. So the Strategic Petroleum Reserve. Right. If we ran it down to the tune of about 60%, there is a time we're going to have to refill it. They don't want to look stupid. Spoiler alert, they're going to look stupid. And if it starts to run, them trying to refill the SPR is going to exacerbate the move.
And this is also at a point in time where Saudi Arabia is very softly moving away from the U.S., right? They're moving away from what they consider to be their reliance on the United States militarily, politically, from a currency standpoint. They're actually open now to doing business in other currencies. By the way, those of you who think the dollar's going away as a reserve currency, none of us who are old enough to watch this will see that. It could happen, but none of us are old enough to see that.
But by the way, I will add about the Saudis, like what we did to them. Remember, they sell oil. We intentionally, and for no apparent reason that I can find other than possibly election, depressed the price of oil. We went out and why would they be happy with us right now? I think it was really kind of a stab in the back to them. You agree with that, right?
Yeah, I mean, all we talk about as a country is getting away from their product.
Yeah, they can't be happy with that.
Yeah,
right?
So why would they drift away from us? You know, when the Saudis talk about moving away from fossil fuels and becoming a more green economy, that's very similar to me, you know, to when, I don't know if I should make an Anheuser-Busch joke. Go ahead, we'll move on.
Okay, no, I don't want to move on from oil yet. Can you pop up?
No, I don't want to move on from oil, but I want to talk about.
Good, yeah.
I don't want to make an Anheuser-Busch joke.
I do, but we'll do it later. Yeah.
All right, let me put up a crude oil chart. Getting one ready, and then I got to share it. Welcome to our first show where I'm absolutely not prepared for what I need to do here. I think I'm actually moving pretty quick.
I do too. And again, it's a first show. If you guys don't expect growing pains, you're watching the wrong show. We are not perfect by any means.
All right, here we go. If you guys can put that up as soon as you get it. This is a daily crude oil chart. So this is what I mean about the pullback. Whoop, hold on. I got to reconnect this session. By the way, I'm in the midst of California. I'm in the midst of a Florida storm, which could take my power out at any moment, just so you guys know. It usually
okay, good. Then I get to talk and nobody interrupts me. It's like
so
a
it usually
dream come
comes
true
back.
to me. Yeah.
It usually comes back. Yeah, you love the sound of your own voice. It usually comes back really quickly, but the internet takes a while to come back. So this is something we talked about, Jimmy. So you can see my cursor here, right? I think I'm going to avoid the pen for now. So I have had this chart drawn in, or I'm sorry, this channel drawn in since about August of last year. Now it's a rough channel, right? I wasn't trading this channel. But what I've always told people, and for those of you guys that don't know who I am, I spent about 5 years, actually more like 6 years, at a boutique oil firm in Chicago where we actually moved barges of oil. Now I came up in the futures market, so I always knew about crude oil, but I became kind of known as sort of a crude oil expert simply because I worked at that oil company and I learned things that as future traders, you just don't learn. For example, how fast crude oil goes through a pipe and that they can't make it go any faster because it damages the viscosity of the oil, things like that. So once I started learning those things, I started trading crude oil a lot more. So I've been trading crude oil as my main futures product. Okay. And one of the things I'm very fond of saying, Jimmy, is you probably shouldn't look at energy companies if you have an opinion in crude oil, because you know it's 100% correlated to crude oil.
Crude oil.
Crude oil. But if you don't have a futures account, some of the downstream names and some of the bigger names usually end up working. They correlate pretty good short to medium term with crude oil, not long term, but short to medium term. They do correlate pretty good. So anyway, this is the channel we've been looking at. Now notice that this channel, this downsloping channel, this is what crude oil does. It operates in sort of a congestive way when supply and demand is basically balanced. Okay, now this was obviously with a little bit of a lean toward more supply, less demand, but still a congestive channel. You wouldn't really call this a trend. If you want to see a crude oil trend, here's a crude oil trend, right? Here's another one over here. This is right here is the invasion of Ukraine by Russia. Okay, these are trends. This is not really a trend. Okay, it's just kind of a sideways, slightly moving down type
gentle sloping, right?
Yeah, gentle sloping channel. So we broke out of this channel, and I don't really care about that. What I care about is that we broke out right around the 200-day moving average. Okay, and now we're pulling back, and anywhere in this area here, I will use the pen for this. Anywhere in this area here, to me, is a retest. Okay. So if we come down and we don't go back into the channel, okay, that's going to be a pretty significant sign. Now we've got to get above this defining point here.
Part of the circle is back in the channel though, but it's just the top.
Yeah, I'm just highlighting it. I don't want us to close back in the channel.
Got it.
All right. Now, if we close back in the channel, spend a couple days there, and then pop back above it and break this high, then that's still a hold to me. Okay, so all of these are areas, right? So this is why, like, people say, why didn't you buy the breakout of the channel? Because I don't know if that breakout is just going to cause me to redraw the channel. So look, this is what this would look like. Let me get rid of this. If this breakout failed and we got all the way back deep into the channel and there was no way we were breaking back out again, I'd be redrawing the channel looking for the same kind of a situation. Let me see if I can figure out how to do this right now.
No, and that looks like a perfectly legit channel as well.
Yeah, it will if I can figure out how to. Oh, I'm still in the pen. That's what it is. All right, hold on a second. Let me get out of the pen here and get back to my cursor. All right. Now I can do it. So if we broke out, if we went back into the channel, I would just be redrawing this channel to look something like this.
Yeah.
Okay. And then I would say, okay, we're back in the channel, and the channel's just got flatter, and crude oil is still operating the same way that it normally operates, which is going within a channel. Sometimes it shifts the channel in one direction, sometimes it shifts it in the other. So based off of this, if any of this retest, if I go back to the old channel, if any of this retest holds, that was pretty slick how I did that fast, right?
That was cool. Yeah, that was cool.
Very, very cool. If this holds and we start to go back up again, you want to look at crude oil, you want to look at USO, and you want to look at crude oil names, okay, energy names. And that will trump.
What names in particular?
Well, I have always liked Chevron for this. I've always liked Chevron as a stock to trade. I don't like sort of the shale names, okay, like not a Devon Energy, they don't really apply, but look at some of the shale companies. I don't like that because of the particular time where this exploration has been bad, right? They've been spending more money and not finding deposits. Okay, so that's why I say you want to look at more of the diversified companies. I love Occidental Petroleum for this. I can actually change this on the fly to Occidental Petroleum. Sure. That's one of my favorites simply because I don't follow Warren Buffett, but when Warren Buffett buys something, you know he bought it long term. Okay. So that means that this particular underperformance here doesn't bother me at all. Right. Yeah. This is a really good example of another retest because it's testing this area right here. You can see this. I will talk about these particular moving averages one of these days. We don't really have time to do it today, but it's going into what we call the rotation zone, which is formed by these two moving averages. And we've got the 200-day right here, which is flat, so it's less significant. The 200 is much more significant when it has a slope to it, like here. But when it's flat, it's less significant. But if you can pop back above this high and above the 200 in here, that will coincide with crude oil holding and breaking back out. So Occidental will be a really good one. I'd have a target of Occidental Petroleum somewhere around $70 at that point.
Nice. A last question about the oil names, and then you want to move on to something else. A lot of the big integrateds pay a sizable dividend. When rates are high, does that make them naturally less attractive than they normally would be and could depress price?
Say that again, because I was looking at something.
A lot of the big oil integrated names are big dividend payers, and they trade like dividends. And also, rates are high, so that's kind of a headwind to these oil stocks, right? Or does that not even matter?
No, it matters. It does. But I've always said when you're looking at something like an oil company, like Occidental has a good dividend yield. Chevron has a great one. Exxon underperforms, but has a phenomenal dividend yield. That should matter, but that falls more under the sort of the category of, to me, of financial advice. So it matters as to what you're doing. If you're looking for like the biggest return on your buck, and I talked about this in one of our podcasts. I'm not going to swear as much as we normally do. I don't give a crap, a damn, a shit. I don't give a shit about outperformance to the upside. I don't care if you made 10% and I made 7%. I don't care about that. What I care about is protecting capital because that's how you last. Right. And that's what matters, protecting capital. So if you're somebody who's in a position where it's like, look, you have a $50,000 account with Tradier or something like that. But if you lose that $50,000, you're in a lot of trouble. Then go to a slower performer like an Exxon, for example, and take the dividend and don't worry about it.
Right. By the way, when I was mentioning dividends, I wasn't talking about collecting dividends. I was talking about stocks that may move faster compared to rate moves because of the dividend.
Yeah, and let me answer that correctly because you also compared it to rate moves. The whole thing of TINA, there is no alternative. People say it went away when the 10-year started yielding 3.5% to 4%. If that were the case, stocks wouldn't be up as much as they are this year. I think that's complete bullshit.
Okay. So you want to talk about stocks and I'll let you let into that?
Yeah, we got another question about crude oil. Okay. So let's answer that. They're going to put it up on the screen for us. What do you guys think about Saudi Arabia's latest push to move away from oil by proposing the line, the giant linear glass city in the desert? You want it?
No. Because I don't know the answer to that. I like to pretend I know the answers to everything, but you know oil better.
Okay, so I'm not going to speak from a cultural standpoint, okay, because I don't know Saudi Arabian culture. So there's going to be a little bit of American/Italian cynicism here. That test city reminds me, and that's what it is, Jimmy. It's a test city, right? It's
kind I read a little bit about it. Yeah, right.
It's kind of a test case of a sort of zero, maybe zeros pushing it, but a zero carbon emission city. China built a lot of apartment buildings and condo buildings that ended up being, there's a great documentary called The Ghost Cities of China or something to that effect. I think that's what's going to end up happening here. If you sell Italian beef in Chicago, you don't test sushi. You just don't. Right? Jimmy has a restaurant in the suburbs of Chicago called Branson Palatine, open Saturday through Sunday. I don't remember the hour. But they do burgers. They do unbelievable burgers and some of the best tater tots I ever had in my life. when I went there to eat, I didn't ask if they did sashimi or, do you have a ponzu yellow white tuna I can eat it?
No.
I don't take it seriously at this point. Now, if there's a cultural reason for doing it, I don't know. I could be completely wrong. I don't know what that is, if that's the case.
Yeah. And I don't mean to, I'm not going to go live in any of your, bullshit, glass cities, zero carbon cities. I'm not ready to do that yet, unless I'm doing it at gunpoint. So I don't think it's going to be a successful endeavor personally, but yeah, it's a good point. Yeah.
Yeah. So let's move on. Yeah. Let's move on.
Okay. Let's talk about stocks, and let's talk about, first of all, again, like I said before, I believe a technical pullback is probably in the cards depending on today's close. What do you got now? Do you see it up on your screen right now?
The market. Yeah, give me a second here. Sorry. This is something I will also get better at. Down 1.51%. We're at 45.3175 in the futures. SPX 45.0948.
Okay, so here's the reason I've been trading this from the short side, and I've had a good day of trading today, which, by the way, the downside of having a good day trading is you think you're a genius. And for those of you who know me and listen to my stuff, I don't need any more reason to be a blowhard who thinks I'm a genius. But anyway, today I had this down move, and the reason I traced it back, we talked about it yesterday on the show we taped, is that back on Thursday of last week, we had that higher high, lower low, closed on the beat low. From a technical standpoint, after the run-up that we had over the last few months, I believe that would be an opportunity for people to take some chips off the table if it settled below the low that we made on Thursday. Today, we are going to do that. I now believe that a correction is in the cards, and I am actually positioned for that. Again, we talked about the fact that options were so cheap, and Bobby said still so cheap. They're not as cheap today. The VIX shot up pretty high today. I think it's close to about 16 from 13.5. But when you get opportunities to put on protection, you take them. Now might not be the best opportunity. Can we put up the 6-month chart? And then we can, now that it looks like we're getting the close I want, we can talk about where our objectives are on the downside.
Chart is in the window. Hold on a second. Let me put it up. All right, there's your S&P chart. I can restrict it to 6 months if you want, but basically this is 2023 right here.
Okay, so do you think that those highs from where is that the high from a couple months back? We'll keep going to the left. I know the highs from like is that out of the reach? What is that level? Again, my old man eyes can't see those levels.
You're about 42. You're about 42.06.07. Again, this is a continuous futures chart for everybody that's wondering.
So if
we could do this down the road. I'm sorry, Jimmy. Down the road, everybody. If you want to see SPY or SPX, let me know. I can put those up. But we're just going to go with futures because of the continuous chart. Let us know if that doesn't work here. So I'm going to drag this blue line there, Jimmy, just so you can clearly see it right here. And that, let's call it 4,200 for lack of a better.
So if we call 46 and change the top and 4,200 here, we're talking about basically a 10% correction down to that level, right?
Yep.
Bobby, for the folks at home, how many times is there an average a 10% correction per year?
Twice to 2 to 4 times a year.
2 to 4 days, right. So an average. And have we had one this year? We have had one this year. Is that one? Yeah, that looks like one from before. But to me, that seems very reasonable that we trade down to that. Now, I have what I had put on, and I've been talking about this for a whole week. I'm not just talking about it on the down day. It looks like it's triggering. What I did to prepare for this is I sold a put that was basically 5% out of the market to buy 3 puts that were 8 to 9% out of the market. So it's a 1-by-3 put spread that I sold the 1 leg, bought the 3 leg. So my theory and thinking was that as we start to go, and it's working pretty well today, that not only will vol pick up, which will help the 3 out of the money puts, but also skew, meaning the further out the skew smile, the further out those puts are, the more people may panic and jump into those. You said these people are a new audience. You give your opinion on that trade, will you?
Yeah, so I really like the trade because I see a number of reasons. Like oftentimes, I'm going to put a line here too, because this particular peak, believe it or not, is not as strong a support level as you might think it is. And the reason I say that is because it's basically only been tested once in this chart. If I tighten the chart up, even in these areas here, it kind of got blown through a couple of times. You might call this a test. But anyway, back to the trade. The reason I like this so much is because I'm going to throw out a couple of stats, and these are stats from work that I've done with my partner, Mike Arnold. Going back to the yield curve, I know we did a lot of talking about interest rates, and you guys might find that boring, but we're going to convince you as to why it's important. The yield curve has been inverted to historically negative levels for a historic period of time. It's too low for too long, okay? When the yield curve inverts, it's a sign of an inflation. There's only been one time the yield curve has been wrong, okay? This could be number two. It could.
Sign of a recession is what he meant to say.
What did I say?
Inflation. Don't worry, I speak, Bob. I'll keep him.
Inflation makes my money recess. That didn't
exactly.
All right, so yeah, it's been the sign of a recession. There's only one time it's been wrong. What are the odds that the deepest and longest inversion is not going to cause a recession? I say that's pretty low. So what happens to stocks? Okay, stocks do not bottom when there's an inverted yield curve until after the yield curve has gone back to its normal shape. They bottom after that, 10 times out of 10. The last 10 times this has happened. So this particular move that I'm highlighting here with my cursor, okay, this move here does not take a recession out of the picture. Stocks have to perform while the inverted yield curve is going back to its normal shape. If they do that, if the stocks don't turn negative, once it's already, and by the way, the bottom in equities doesn't come until after the inversion is finished and we've steepened already.
Okay, can I tell them?
We're nowhere near.
Can I tell them why that happens, though?
Go ahead.
Which actually, Bobby helped coach me through this about a month ago. So when the yield curve starts to head back to zero, it will mean a couple things. It will probably mean, if history is any guide to this, that the Fed will have overshot, got to a point where burning timbers are falling from the ceiling, and they rush in to depress short-term rates, their tool. So when they depress short-term rates, that's the main thing that's going to be steepening out the yield curve. I get confused because it's technically steep inverted, so it's going back to zero, which is technically flattening. But again, it's semantics. That'll be the thing that steepens the yield curve out. It means they're depressing short end rates, and that will be at the same time that there's a panic in stocks. It's usually a panic in stocks that accompanies whatever the dominoes are falling that freaks the Fed out. Did I describe it properly?
Yes. Okay. And that brings me to the next point. It has to be, it doesn't have to be, but it's more likely that stocks will fall and then bottom if the yield curve is steepening in a bearish way. Now, what do I mean by that? The yield curve can go back to its normal shape with rates rising or with rates falling. Right now, it's doing it with rates rising. That's not good. That's not what we want. We want it with rates falling. So why do we want it that? Well, we want the stocks to actually bottom versus their historical factors that cause them to bottom, so that not only can we trade from the long side, which everybody's got to admit, trading from the long side is more fun, right? Because monkeys can do it, and I tend to trade like a monkey. So trading from the long side is fun, and if we get that inversion to go back with interest rates falling, you're going to have a dramatic decline in stocks, and 10% could do it, by the way. But it can be the true bottom. We don't have to break the October lows for this all to play out correctly. So when people are talking about, I hope a recession doesn't come, I hope it doesn't either, because I don't want people to be out of a job, right? And we do have to have employment get a lot worse. But I do want stocks to bottom so I can buy more of them for the longer term. Right. So don't be afraid of recessions in terms of from an investing standpoint. Okay. From a home standpoint, I get it. From a losing your job, I get some different thing. So it's not out of the realm of possibility to fall 10% at all. That was a long way of saying that.
No, that's fine. Totally. Again, I need time to nap too. So when you want to go on your long rants, just give me a clue like this. Sorry, hey, guys, we've been doing this a long time. Yeah. We will give each other a hard time. And I hope you're
Do you mind if we talk a little bit about the payrolls number that's coming up?
Not at all. I think we should.
Because I'm going to put a couple things up now, and this is going to take me a minute as well. Actually, I don't even know if I'm going to be able to do this. I'm not. So I'll save this. Well, I can't save this.
I'm going to say one last thing about stocks while you're trying to get it up too. Is
Go
that
ahead.
I need to settle below 45.50. I'm reiterating this again. We've popped a little bit. My screen right here says right now 45.38, and we got 9 minutes left in the day. If we settle right on it, the market has a way of confusing the shit out of the issue and making it less clear. If that's the case, then I want to see some downside tomorrow before I increase any of those shorts.
So what I wanted to point out was that we have some labor force growth going on. And I'm still trying to figure out if I'm able to share this while I'm talking to you guys, but we have some labor force. I can't do it. I'm going to work on it for next week, guys, but we have some labor force growth. We have labor force growing by about 60 basis points a year for the last 5 years. Okay.
Hold on. What does that mean? Labor force growing by 60
the size of the workforce.
Right? Oh, it's growing by 0.6%. Right. Okay.
Yeah, it's been growing by 0.6% for about 5 years. And when you do the math, considering that the labor force about 167,000 5 years ago, it's been growing by about 81,000 jobs a year. People.
167 million.
Yeah, there you go, 167 million. So it's been growing by about 81,000 a month over the last 5 years. So 81,000 is the baseline of jobs. Now, what I wanted to put up was the last few months of job numbers. Other than these individual spikes, it's been a downtrend in terms of the monthly figures. Okay. So if you were that kind of person and said, well, let me take out these outliers, you would have a solid downtrend. And we're approaching that 81,000 level. When we hit that level where 81,000 jobs were added, all you did was take care of the workforce population growth. That might be a better way to say it. And you have not added new jobs. Okay, that'll be your first sign. So when we get down to, if we get down to 150,000 jobs, 120,000 jobs, you guys keep in your thoughts how close you're getting to that 81 to 85,000 new people entering the workforce level. And that means that a spike in the unemployment rate is likely coming. And the Fed wants to see that. And as soon as they see that, start looking for Fed speak that says, we might need to cut rates, or paraphrases, we might need to cut rates. I think we might be sub 200,000 this particular Friday.
Okay. And I will add to that when you take out that nonsensical birth-death model, which is terrible at turns, and for you people who don't know what the birth-death model is, it has nothing to do with actual births and deaths. It's about companies being created, new businesses, and it's a backward-looking average that they add into the number. Meaning if the market's turned and all of a sudden the economic conditions have grown more negative, that they are looking at the wrong window. So the birth-death model is adding a lot of jobs to the headline number, as is government jobs. If you took them out last time, that number would have been a lot more ugly than the headline looked. And so I am believing, and again, if anyone wants to know what my opinion is of the coming recession, that Substack that you put out, was that this morning or was that yesterday morning? These days,
yesterday morning, yeah.
I wrote it and Bobby published it. You can go to his Twitter page. And I believe that the delay of the recession is due not to the as much to the rapidity of the rate hikes as it is to how low rates were for the 5 years that ended with the first hike, meaning that all the consumers and small businesses who needed duration, locked in duration. So a lot of those people just sitting on the sideline going, geez, I'm glad I don't need to borrow money at these high rates. And I think that's delaying the recession. But I think when it comes hard. You agree?
I do agree. And I really wish we were doing the show yesterday, because you and I yesterday talked about puts and selling calls and why those were a good thing to do right now. We talked about the relationship between options and your portfolio and how options is sort of like insurance. Well, actually, that's the original purpose of options, right? Is insurance. It's like car insurance, where you bet every month with your insurance company that you'll get into a car accident, and they bet with you that you won't, and you lose that bet every single month or every 6 months, right? You'll lose the options as insurance bet most months, right? You'll lose it. Jimmy was talking about how he's, it's costing him money to buy some of these puts and to do some of these trades. that were insurance for what might be a downturn. And these are the reasons you do it. If we're right that this well, let me rephrase that. We're not wrong that this downtrend can extend. We're just not saying it will. We're saying it has the possibility of extending, especially when you look at things like the downgrade potential and other things that are going on with crude oil and the Bank of Japan and other things we talked about. So when you're looking at that from a perspective of that, when insurance is cheap, you should think about taking a little bit of your profits and buying some of it, or taking some profits in the form of covered call spreads, whatever.
Right. And I'll add too, the options position I had on, the selling one, buying the three that's 8 to 9% out of the market. I don't need the market to go below those levels to take a lot of profit on that. I'm not looking necessarily for them to be in the money. I'm looking for the pop and vol and the pop and skew, and then I will take them off or roll them into something that's more attractive to me. So that's why even if it breaks down, like if we lose 5% and you're like, oh, it's right in the middle of your your top to bottom of your spread, I don't care about that because I will still make money on that, right?
Right. So those are the structures. So, you
want to call it, or you want to do one more asset?
No, we're running out of time, so I want to call it. But what I do want to do is, this is going to be a weekly thing. So if you guys have questions that you want to make sure we get to, reach out to Tradier, get them to us ahead of time. That'll always help. But you're always welcome to put questions in the middle of the show. Tell people about the show. We're going to be here for a long time. We're not going anywhere. So.
And it's going to look different as we move on. We're going to bring in some guests. And one thing that's cool about Bobby and I being in media for the last 20 years, meaning trading for 20 years, for 40 years, is that we've made some cool relationships along the way. So there will be some amazing guests. I do want a bunch of input from you guys who are watching it too. I look back at this show, I wish we would have gotten to a few more assets to chart them out at least, but I want to know what you guys think as well, because we want to tailor this for you. Is that it? How do we sign up? Do we have we'll get some symbols or bang a gong or something that means the show's over?
I think our guys will take care of that.
Shows are always so hard to end. It's like a phone call with your girlfriend. Like, no, you hang up. No, you hang up. So
guys, I think you should just cut us off. Just whenever you want, cut us off and put up the outs. Put up the outro.
Thank you, guys. Yes, here we go.